What's going on, world? Thank you for tuning into another episode. Today, I have a special guest here on the podcast, Bryan, one of my great friends. You know, he works for Charles Schwab, and he actually is a stockbroker with the company working in their investing services team. And today, what we really want to talk about is where the economy is going. We've heard a lot of talks when we think about inflation, the Federal Reserve with interest rate hikes, and then also just all of the uncertainty that we're seeing in the market. We really wanted to take this episode to give you all like a market outlook, some things you should be paying attention to, and as an investor, how you can properly prepare for the changes that we're going to see in our economy. And if you all can just continue to like, subscribe, and share this video on YouTube, and then also if you're listening on a podcast, rate, leave a review. It definitely helps. And don't forget to hit the notification bell so you can always be notified whenever I'm dropping content every week. But with that being said, Bryan, welcome to the show, man. I'm glad that you're here.
Hey, appreciate you having me, man. It's definitely a pleasure. Definitely appreciate what you're doing, giving great content, great information that, I feel like everyone needs to, be queried to and definitely, be up on. So definitely appreciate you.
I appreciate that so much, man. And to get things started, can you kind of share with the world just your background and also what encouraged you to want to go into the finance industry?
For sure. So really my journey really started and where I kind of piqued my interest was probably back in, I believe, 2016. So originally what honestly got me into investing, or kind of at least made me aware of it, was a mutual fund. So going into college, my dad had basically started a mutual fund for me when I was a child to kind of help prepare for college. So when I was in college, basically that was kind of helping out as well. And then I had a football scholarship at Florida A&M. And so whenever, I need money for like a little bit for tuition or books, I would use some of the mutual fund. And then from there, 2017, I got into crypto. And from there, it was just so much information, so much learning, because really to understand crypto, you have to understand how our current monetary system and kind of bank system works. And, 2017 happened to be a great year for, investing in general, with being involved with, OTC, weed penny stocks, canopy growth, Aurora, things like that, at the same time as, Bitcoin popping up too. So 2017 really, that's when I realized, I was a junior in college. And so I was like, at this point, it's like, this is something that I really want to do. But at that same time, I was already, my background is really like health science. I was really going to college to be originally a physical therapist. And then from there, I was thinking about being a chiropractor. But at that time, I was already so far down the road that I was just like, I'm not even going to switch my major. I'm just going to kind of do this, as like maybe like a passion project or like a hobby on the side, just because, the key elements to life are really, health and wealth, so they kind of feed off each other. And so how I got involved with Schwab and TD Ameritrade was really just I can't even say it was necessarily me. I kind of just fell into it. I ended up moving out to Dallas for insurance, being a claims adjuster. And, unbeknownst to me, I wasn't even really aware of how much opportunity was out in Dallas. I just thought it was, underrated, kind of a cool city. But once I realized, what's all going on out here, it was like, wow. And from there, I ended up leaving the insurance job to really pretty much just day trade, honestly, because at the same time, I've been trading Forex independently since 2018, 2017 as well. And when the pandemic hit, I was sure that crypto was gonna pop, and I was like a year too soon. So then from there, I was, I love to read, love personal development. So I was thinking, let me kind of gain some sales experience. So I did like cellular sales, Verizon for a little minute, and then just talking to clients, because Verizon's kind of, their clientele is different from we'll say Boost Mobile, for example, not to be any type of way, but one day I ended up just talking to a client, and it turns out this person was a like a treasurer for a local hedge fund in the city. And before I realized that, it was like the next day when we kind of exchanged contact information. But it was like, wow, we really haven't. That kind of just showed me like what I knew matched up, and I was able to communicate these things with people in the industry. And from there, ended up getting an interview, not with that company, but with maybe like a subsidiary that kind of helps in tandem with investor services. And at the same time, my cousin, he worked for Schwab, and I kind of let him know my interests as well. And so ended up having interviews like the same week, and really hit it off with the people at TD and Schwab. And from there, kind of just here I am now, past the Series 7 and 63. And yeah.
Yeah, it's great to see your journey, man. And we have a very similar background. I actually in college studied sport management. So my whole career journey was I wanted to really work in marketing and business development, in the NBA. Like that was my dream as far as the direction I was going in with my career. But I think, I kind of navigated and transitioned to financial services just because the power of just financial literacy, I felt like it wasn't enough of it in the Black community, and
Right.
ended up going back to school for my MBA, and really allowed me to be able to just understand different aspects of business, both, here domestically and internationally. So, I think that you talking about going into physical therapy, I got a chance to work alongside different people that worked on the physical therapy side and sport management. And, I think that when you're talking about your experiences working in sales with Verizon, I actually got a lot of good experiences working with AT&T. So, it's just,
man.
it's interesting to hear your journey and my journey, and just how we both kind of had similar backgrounds, but now we're in something that we really enjoy as well. And with us recently being licensed, I think it's really going to give us the knowledge to really be able to help and educate a lot of people. And, I wanted to really start this conversation off and talk about, an aspect of the economy right now that's playing a prevalent role on just economic growth, as far as a slowdown of economic growth. And what I'm talking about is inflation. When you think about inflation, we look at the numbers with the consumer price index. And for those of you that don't know what the consumer price index is, also known as the CPI, it's simply a measurement of a basket of goods, and it's measuring the increases and the decreases of basket of goods. So anything such as food, shelter, energy, commodities, you will see these type of things in a CPI. And recently, for February of 2022, CPI rose to 7.9%. Now, these are the new metrics, and a lot of people have said that if you've looked at the old metrics, a CPI, our inflation numbers are actually double that, 14, 15%. And the reason being behind that is because with the new metrics now, the way they calculate shelter, it plays it's like about 40% of the CPI. The way that they measure shelter is they pretty much just do a survey of homeowners, and they pretty much just ask them, what would they rent their homes out for? So a lot of analysts and economists think that this is very manipulative to show a lower CPI. And some would say that it's very hypothetical and that, what homeowners will tend to underestimate rent amounts during expansionary periods, and then they will overestimate during recessionary periods. So I wanted to share my screen with you all with inflation on the old metrics that was calculated back in 1980, because I think that this might shock a lot of you when you hear whether it's these major media outlets, they tend to, I guess, go away from the truth. I'm not going to say all of the media outlets, but, if you can look here, this was based on how inflation is calculated. And this website, for all of you that are wondering what this is, I'm using a website called shadowstats.com. And the guy that created this website, his name is actually John Williams. He's a U.S. economist, and he also had a lot of great experience with just government. He was a government analyst as well. So he really understands these numbers. But this blue line at the top is pretty much what our inflation is really at when you look at the calculations with the old metrics back in 1980. Of course, the red line is where we're at now, so about 7.9%. But when you look at that blue line, you're looking at about, 14 to 15%. So when you think about that, Bryan, I really just wanted to get your thoughts on, how do you feel about inflation, this year for 2022, and just how it's playing a role with just our economy?
Well, it's certainly prevalent and obvious, kind of piggybacking off of the chart there and what you stated about CPI. The best way that I've kind of heard it be explained in the sense that it can potentially be manipulative is the way it's calculated now is almost the same as how the weather is calculated, right? Like, for example, it's almost a national average, right? So if we were to put this in weather terms, we wouldn't calculate today's weather based on how the weather is across all 50 states. Because then, people in Alaska may end up coming out the house in shorts, or, somewhere people in Hawaii might come out the house wearing like an Eskimo suit. So that's kind of how the CPI can be manipulative in the sense that, based on all 50 states, CPI is, I believe, I guess the last number might have been like 7% or somewhere between 5 and 7%, when really, depending on where you live, it might actually be 14%, depending on how much, gas prices have risen, grocery prices have risen, housing prices have risen. So, sometimes it kind of can be deceiving for, it can definitely just be deceiving, but as far as inflation, it's definitely, it's a tricky topic. Well, because when you think about it, this isn't it doesn't seem to be our traditional inflation, in the sense that it's really, because it's really just seems like we've lost a lot of purchasing power as citizens due to the amount of money printing that has taken place over the last, decade, and especially during the pandemic, when 40% of the entire money supply was, printed into existence. And so it looks like we're kind of feeling the delayed effects of that in tandem with supply chain issues and supply as well. So, when you look at housing prices, comparatively from 2008, what happened there, here you got, the cost of lumber, there's like a lumber shortage, all that. So the prices of, materials went up. Then, you take a look at, there's not enough houses on the market. So there's, multiple people bidding on one house. And then you look at, who's also getting involved as buyers in the market. There's banks buying up these houses as well. So the average person is getting priced out, especially in places, potentially like, like Florida, Texas, where, you have people from New York moving to Florida, and you have people from California that are able to, purchase these houses in cash comparatively from where they, from where they originated. So it's a lot of factors coming in that might take away from what's happening, because originally inflation would happen due to it'd be a good thing in a sense, right? Like people earning higher wages, just a influx of consumer spending and people making money. But that really hasn't been the case. There's we're still in what is called, I believe, the Great Resignation, where people are leaving their jobs, quitting, and so there's a lot of variables that it's like a Chinese proverb. It goes, "May you live in interesting times." And so when you look at that, going in top of like a once in a lifetime event, which is the pandemic, and then for it to kind of, I wouldn't say disappear, but, disappear maybe out of the news cycle. And then now we're, kind of going into this whole, Russia-Ukraine thing, which has an effect on oil prices and gas prices, which, to a car, it's annoying, but for planes and transportation vehicles, that's when it gets expensive. If you look at, flights 2 months, 3 months out, they're, really high, and so all these, sanctions and things like that kind of fall back on the corporations within. They price those in for the consumer as well. So, I guess that's my spill on that.
Man, it's so many different variables. I think just to put the inflation into context for the people listening and watching, with 7.9%, essentially what that's saying is if you have $100, it's not worth $100. So it's 7.9% out of that 100. So you only have $92. Your $100 bill is only worth $92 with inflation being at 7.9%. And if we're using old metrics and let's say it's 15%, you're looking at $85 that $100 that you would think it would be worth. So it just really goes to show that the value of our dollar has tremendously devalued. And kind of like what Bryan is talking about with the supply shortages, from when we see the prices of homes just skyrocketing, it's because there's so much demand, but there's not enough supply with materials like lumber to make some of these homes. A lot of that has played a big role in just, wage inflation, I'm seeing with a lot of different fast food restaurants having to increase wages to be able to combat against inflation or to attract people to want to work for the company. So it's just a lot of variables going on right now. And like you said, with the uncertainty with Russia, Ukraine, there's a lot of things that as an investor, you want to educate yourself on, because, as an investor, you can't always just worry about what's going on here in the U.S. But I think you have to look at things globally and see how that can impact you as an investor long term. Now, you mentioned, Bryan, about how with the Fed, a lot of this inflation has came from just monetary policy, just all of the money that has been just put into the system. And when I was looking at research, I was seeing that, the Fed has came out in their most recent Fed meeting. They're saying that in May that they actually want to cut back on reducing their balance sheet. Their balance sheet is like at $9 trillion. And that they want to reduce buying just like treasury securities, mortgage-backed securities. And when I say that, everyone, a treasury security is like think of it as government debt. So like a treasury bill, a treasury note, things around that side. And a mortgage-backed security is pretty much like a home, a security when it comes to a home. So when you think about the elements of them coming out and saying that they want to reduce the balance sheet, what I really want to know is, do you think that they really are going to start reducing their balance sheet in May? Because when you look at physical and monetary policy, which physical policy is on the government side and monetary is on the Federal Reserve side, is somewhere around $10 trillion of debt. So there's a lot of debt in the system. And I will argue and say that this has played a big role on us now seeing the after effects of inflation, because there was so much money for the pandemic. And granted, I do understand that they had to put it out there to help the economy kind of recover. But I think that a lot of times when I think about our monetary policy and even our fiscal policy, there's a lot of bailouts. There's a lot of having a safety net to help companies that don't really, deserve the funding. Like, I think that the market they have to allow the market to correct itself on its own, allow the free market to actually work the way that it was designed. So I think there's a lot of meddling and trying to prop up and keep kind of kicking the rock down the road to prevent any type of ramifications of a recession or a big correction in our economy. So I just kind of want to get your thoughts on that. How do you feel about that with the balance sheet, with the Fed, and just them coming out saying they want to reduce the amount of spending?
So, I mean, this is a great topic, probably going into the yield as well, but sorry. So going into that, I mean, we live in a debt-based economy. So the balance sheet, it could be a blank check. They can make up a number. They could be a quadrillion, quintillion, all these, random numbers. The debt ceiling is just going to it can just keep on being raised, So there's two things, two economic theories. You have the Triffin dilemma, and then you have the Cantillon effect. And so with the Triffin dilemma, it's basically, a double-edged sword of the fact that a country's currency is now the world reserve currency. And so it becomes like an international issue more so than a national issue, right? When it comes to money printing, because when you kind of help ease, pains of the nation, right? The world kind of feels the effect of the devaluing. Whereas, as well as like the purchasing power. So, the dollar, on a global stance is actually getting stronger. Whereas purchasing power for the citizens is getting weaker, and we feel that in inflation. And the main reason for that is because a lot of debt is denominated in dollars. So whenever someone pays back a loan or debt, like a sovereign country, they pay it back in dollars. Or like if you look at someone like Evergrande that might default, or even Russia might default on some bonds or loans, those come back in dollars anyway. And then for the cotillion effects, it kind of goes to the topic of, when these bailouts happen or when new money is printed or put into circulation, it has a trickle down effect. And so the people that get the money first get the purchasing power and the rewards of that new money. But as it trickles down, the people at the bottom that get it, which is normally, the citizens, all they feel is the inflation and the loss of purchasing power, because that new money has technically already been spent and used. And now that flex in the prices of goods and services for those people that get the money at the bottom. And so as far as what the Fed can do, looking at the 10-year treasury yield, it's been going down since the 80s, and, really with that, it appears to be a result of the dollar, 1971, I think August 19th, The dollar went off the gold standard, and just became like a fiat currency. From there, interest rates have been going, as close as possible to negative or to zero, where it made money easy and accessible to be borrowed, especially by like corporations and things. So for the Fed to try to raise rates, it sounds really good, but I mean, technically the system, wouldn't. I think 10-year Treasury yield might be somewhere around like 2.3% or something like that. They'll be lucky to even get to 3. Like, so, so I don't think, I guess the best example, because I mean, even with inflation, right? Fed Powell for the past year was saying, inflation is transitory, right? Kind of using these sexy words, right? Oh, transitory. Oh, that doesn't sound so bad. But like transitory in a sense just means, it'll go up all of a sudden and then steadily increase from there, which really is just like a nice way to say, yeah, inflation's here and it may not really be going away. And so like basically from there, anything, even with the treasury yield and even with the yield curve inverting, you really shouldn't, I don't think we should really expect them to say anything that would incite panic, because basically our money is really just based off the trust. And so if they say anything that will allow people to panic, that's never good. When people panicked last time, it came down to toilet paper, right? Because when people panic, anything seems like a good idea. So, the best way I can explain it, and it's funny, hear me out here. It's almost like, they're probably gonna have talks saying like, hey, there's no recession, or, there shouldn't be time to worry, even though the historical data shows that, hey, if this happens, it's almost guaranteed. But the best example I can say of what they're trying to do is, if you ever, have you ever been in when you're growing up, have you ever been in a tornado drill?
Yeah, I definitely have.
Right. So they just tell you to get in the hallway, put your hands over your head and sit by the wall.
Yep.
Basically, they just don't want you to panic when they get blown over. Like if a tornado run through there, they don't want us to trample over each other trying to run out the building. They just want us to be, nice and calm, feel like a sense of patience, sense of protection to get wiped out. And so that's exactly kind of, how the Fed kind of goes about things. So, or even just governments in general, nobody wants panic. Even with the pandemic, they don't want people to panic. So when it comes to things like that, you just have to be, well read, or just, up on kind of what's happening, and don't wait for them to kind of tell you what this necessarily means. You know what I mean? Because even Steve Kramer, per se, right? Like you just can't, I guess a good term is like the revolution will not be televised.
Yeah, that's so true, man. And I think that with the Fed, I think it's important to listen to their meetings, but I mean, we're talking about a Federal Reserve that had a target of inflation for 2% this year. Over the last 3 or 4 meetings, they kept saying, like you said, transitory, our target is 2%, and now we're sitting at 7.9%. So I think that they know that this is, they're in a situation where they have to find a soft landing of trying to raise interest rates just high enough to prevent the world from going into a recession, and just trying to also keep them low enough where, they don't want to slow the economy down. They can't have the best of both worlds. It's either going to be, slower economic growth, or it's going to be like a recession, which those both kind of tie in the two together. But I think that they're in a situation where it's kind of like they're in a lose-lose situation in my eyes, because I feel like inflation is already running rapid, and they have to raise interest rates to get it to come down, and that is going to lead to some slowdown in the economy. And a recession is not necessarily a bad thing. It's just
Right,
pretty
right.
much, it's a slowdown of economic growth. And when you think about recessions, depressions, that's when you can really, as an investor, can find opportunities, and you can find discounts. You can be able to buy up, whether it's some stocks, some crypto, some gold, silver, and you can be able to be in a very good position when the recession passes. That's why we're explaining it, so you can kind of properly prepare. So if something does happen, you can be able to take advantage and be able to ride that wave. But I definitely did want to get your thoughts on just the Fed tightening. With interest rates, they've came out and said that they're going to increase it, 0.25 basis points. And for those of you, the 0.25 basis points, all that means is if we have a 2% interest rate on mortgages, that's going to move up to 2.25%. So I wanted to get your perspective on, like, how does increased interest rates affect, like, people in the economy from just like a borrowing standpoint, and do you think that the Fed, are they going to be able to raise interest rates where it can prevent us from a recession, or is it pretty much inevitable at this point that regardless we're going to have some type of slowdown in the economy?
Yeah. So for that, this might sound a little odd, but the Fed needs a recession, right? So, like, because a recession is the natural way for it remedies inflation. Historically, that's kind of like the natural remedy of like stopping inflation. So, 8 out of 9 times the Fed's record on triggering a recession is from trying to fix inflation, So that's, so it's kind of like baked into the case, kind of just like, we've had, maybe like 16 years or, a decade of, positive exponential growth in our markets, And so what a recession really kind of is a, like letting the air out of a balloon, a nice little correction in a sense, so, from there, it's kind of like what that means though is, like, from the way that I kind of maybe interpret it, is that, like, these indicators really don't mean much for people in a sense at the bottom level, but what the yield curve and everything like that really indicates is corporations and banks. So what that really means is when the yield curve inverts, it really shows how banks are going to go, like how banks are going to start tightening things up. So usually, the yield curve, slopes up. And so, what that really means is short term is going to have a lower yield than long term, And so once that becomes inverted and the short term bonds have the same yield as like long term, banks lose money because banks borrow at the short end of the curve where rates are low and make money from lending out on the long end, So they get paid off that difference. So when there's no difference, the spread is tight, they actually have to raise the borrowing requirements, to make sure that they get paid back if there's really a tight spread, to kind of, make sure that there's no default. So, but for normal people, that don't necessarily, obviously that means something, but that kind of solidifies a recession or downturn when banks have to tighten, their lending requirements, because that's how they make money. Banks don't want to hold our money. That's why there's not, we don't really get any interest from savings accounts, anything like that. Like, their job is to, lend out money. And that really shows the economy's health if a bank cannot lend out money, or they have to, tighten their requirements. So, so as far as that goes, once that happens, that actually solidifies a slowdown. If that kind of answers the question, I might have.
Yeah, no, it definitely does. And I just wanted to also add to that when interest rates increase, essentially, borrowing as a consumer becomes more expensive. So you'll see interest rates on credit cards to go up.
Yeah.
Tend to go up. Mortgage rates will go up, like I mentioned. So you got to think that debt is just becoming more expensive. So as these rate hikes increase, there's going to be less economic activity. There's not going to be as much borrowing in the economy because debt is more expensive. And also touching on what Bryan mentioned about the yield curve, I wanted to explain to you all that, when a yield curve inverts, it simply means that the 2-year yield is higher than the 10-year, which causes the inversion. So like Bryan was also speaking on, that the yields of the short-term government debt, they have been rising quickly. So they've been higher because of these frequent rate hikes that we've had, and the ones that we're also going to have throughout the year. And then with the longer dated government bond yields, like the 10-year, they're moving at a slower pace because of concerns with Fed tightening. So that's why you tend to see that inversion. And, when it comes to the Treasury yield, these are just simply short-term and long-term debt instruments that the government will issue. So like Bryan was saying, a lot of this is mostly on the corporate and the banking side as far as their lending protocols. But it's important for you as an investor to understand how rate hikes impacts you when it comes to borrowing debt. And, I know a lot of people have been looking at the 10-year and the 2-year and the 10-year as a possible indicator for a recession because they're pretty much have been stating that, in history, I read that in history there have been 28 times since 1900 where the yield curve inverted, and 22 of those times a recession followed. Now, a lot of people don't know when the timing of when this is going to happen, so you kind of got to take this with a grain of salt. I'm not saying that something is going to happen immediately, but you can look at a chart, which I'm going to show you all briefly, where you can get an understanding of something that potentially can happen, because it also stated that from the last 6 recessions, when there was an inverted yield curve, it ranged from 6 to 36 months. So typically that would probably get us out somewhere close, to 2025. But, all of this is just educating yourself and understanding what's going on, from an economic standpoint, so you can be able to properly prepare. So I'm going to go ahead and show my screen to you all so you can actually see how the yield curve has inverted. And this actually recently just happened on Tuesday of this week on March 29th, 2022. So it kind of has been gradually starting to go back up, but I just want to kind of put this in context for all of you all that is watching this and listening. So, if you look more recently here, you can kind of see that it's starting to dip down. And, it's still kind of forming now, as far as going back up. It's not much data showing what it's going to do moving forward. But if you look at the history, if you look back to 2019, September of 2019, really August, it inverted. And then when it got to March 22, as most of you know, we had the pandemic. We had a big correction in the market. And then even if we go back to the financial crisis with the mortgage crisis, when we talk about the recession back in 2008, we actually had an inversion in December of 2006, but that recession really didn't come until like beginning of 2008. So this is what we're saying about how, the timing of it is not really certain. Like it can be, I would say that over the short term, we may not be going into a recession, but on the long term, we possibly can. So you can look at data like this and you can be able to get a better understanding of where we're at. And even if you go as far back, when you think about the dot-com era with internet stocks, back in 2000, we had an inversion, around February 2000. And then when we got into May of 2001, there also was a correction. So this is a very good indicator to look at. And some also have said this is another chart. This is the 10-year and the 3-month treasury yield. As you can see here, there's not a big inversion. You can see a widening. So as you can see, it's starting to simply go up. It's an upward trend with the treasury yield. So some have said that's why this is more over the short term. They don't really see any action. But when you look more over the long term, we can have some possible activity of a possible recession. So, and what I'm going to show you all is the 4 stages of the economic cycle, so you can be able to have a better understanding of where we're at now in our economy. We'll take a look at this.
Economic data is easiest to analyze after the fact, but a little digging can shed insight on where things stand and what sectors offer investment opportunities even in the midst of hard times. Here's a list of the 4 basic stages of the economic cycle and some telltale signs associated with each. An economy in full recession has seen its gross domestic product retract over 2 consecutive quarters. Interest rates fall and consumer expectations bottom out, while the yield curve remains normal. Economic sectors that usually profit most during recession include cyclical and transport industries near the beginning of the stage, plus technology and industrials near its end. In the early recovery stage, the economy begins to pick up. Consumer expectations rise and industrial production increases. Interest rates bottom out and the yield curve starts to get steeper as well. Sectors that are successful in this portion of the cycle include industrials during the beginning, basic materials, and energy near the end. In the late recovery stage, interest rates rise and the yield curve flattens. Consumer expectations drop and industrial production is flat. Sectors that succeed typically include energy near the beginning, staples and services near the end. And in the early recession stage, consumer expectations are at their lowest. Industrial production falls, interest rates reach their highest, and the yield curve flattens or inverts. Sectors that do well in the early recession stage are usually services near the beginning, utilities, cyclicals, and transports near the end.
So that just kind of puts things into perspective as far as, we're mainly right now we're in a late recovery stage as far as interest rates are going up. We're seeing supply production being flattened out. So this is just trying to give you all a perspective of where we're at. And as you notice, energy, like they mentioned, tends to do well. Right now, we think about what's going on with oil, with nickel, with gold and silver. Any of these type of commodities, energy has done very well. And then when you look at utilities and transports towards the end of the recovery, going into the early parts of the recession, those tend to do good. So I want to get your thoughts on that. Where do you think we're at right now as far as, the economic cycle, and what do you see as far as with what we talked about with the inverted yield curve, how that is playing a role with a possible recession in the future?
Gotcha. So to answer this question, I guess I wrote me and my friend, we wrote an ebook last year, the year before last, and it kind of went over it was basically like the history of money and empires, right, and world reserve currencies. And the average world reserve currency only lasts about 200 and something odd years, and or empire as well as that. And so we're at like an inflection point of, the American empire, as well as how long a reserve currency lasts. And so, I think what's, eventually going to have to happen is a new Bretton Woods, or like a new monetary system, agreement between the nations. And so I think, maybe in the big picture, all of this is potentially kind of moving us in that direction. just inadvertently, not even maybe because people are planning it, but just, it's just maybe just baked into the cake. So I think, with this upcoming recession, I think it, it will, really kind of put things maybe into perspective as far as, how things will look going forward, but with that, there's going to be, I feel like what it'll be is, really the last straw that breaks the camel's back in the sense of this transition that's been taking place from the industrial revolution type of economics that we've been on into this digital economy and this fourth revolution that we're going into. So, when we look about, NFTs, the metaverse, automation and things like that. I think I just butchered that. But, this whole work from home environment, things like that, it'll kind of really thrust us into that, world because, with us having the world reserve currency and it being our, currency of transaction as well, we feel these effects of inflation of, last. So by the time we feel it, and we're feeling it now, it's already over, because all the other parts of the world have been feeling it as well. We're just the last to feel it, which means it's basically coming back full circle. So when you look at what's kind of happening, you look at in the emerging markets, whether it be South America, places in Africa, India, they're really adopting crypto and, they're making it legal tender, like you see what happened with Ukraine based off of this confrontation. And, what, what hasn't really been seen is just how, I feel like other countries and nations have been kind of itching to get off the dollar standard based off of how we're able to use it as a weapon, as we were able to see with Russia, as far as, kicking them off of SWIFT, not allowing them to be, accept Visa, MasterCard, all the different payment systems, kind of booting them off. Before, we do that to Middle Eastern countries, but, Russia being a powerhouse as well, they might have enough to be like, well, hey, if you want to buy oil, you have to buy it in rubles, right? But the better play, I think, that people may not really see coming potentially would be Russia saying, hey, if you want to buy oil, you have to buy it in Bitcoin, you know what I mean? Or something like that, or maybe like a digital currency, which would be like the power play in that, because technically now, the only hard money around is crypto, so going into this recession, I think it'll, allow opportunities for a lot of wealth, but just for people that are able to adapt, to what's coming, kind of see what the next move is, because that's, obviously with the pandemic, it kind of accelerated the collapse of like brick and mortar and, normal, face-to-face jobs and things like that. I think we'll just see an acceleration of that, because on top of the big resignation that's been taking place, like now, people now have the option or luxury to say, hey, you know what, I quit. If you, I can, I can get paid higher somewhere else, or I can make maybe the same or more on unemployment, et cetera. Right now we have that luxury. If the recession hits, there's not going to be that luxury. People are going to be trying to break down the door, trying to get back in when they left, and it's not going to be there anymore. So, with that, it's just going to be, I don't know, a really big transition. I guess the one thing that like I can say is, it seems like that'll be the power shifting from, west back to east, in the sense that, in my opinion, Europe doesn't do anything. They've just been kind of living off their old legend as far as like what they did, like 200 years ago. They have stalling birth rates. That's never a good sign. And America's, population growth has kind of taken a hit as well. And when you look at the emerging markets like places in Africa, India, those areas, they're, like the same way that the internet leveled the playing field is the same with information. It's the same way that crypto is doing with finances and monetary leverage, So that's what I kind of basically see going on. I mean, also to take into consideration, if the recession does hit, like 18 to 24, 18 to 36 months from now, that would leave it around maybe like 2025.
No, you're good.
In 2024, and
Yeah.
that's big always, just because that's an election year.
Yep.
2024, that's going to be a big election year. As well as there's a lot of roadmaps around that time for, I believe it might have been like the IMF and a lot of other,
The International Monetary Fund.
Yeah.
You talking about the International Monetary Fund?
Yeah,
The IMF.
exactly. And even some cryptocurrencies, some of their roadmaps, have a pivotal moment in 2025 and 2030. So,
Yep.
I don't really, I don't have a crystal ball, but, I do know that we're, really interesting times, and the best thing to do, it wouldn't be, I wouldn't say fear, it's more so just opportunity, because there's not many times that there are going to be massive opportunities, So really the same opportunities that the pandemic created are going to be the same opportunities that, this next downturn, will present, and as far as investors, it's pivotal to have, cash in hand and, be able to, take advantage of, the opportunities present, and kind of just like a hurricane, be kind of prepared, understand what, hey, if we have a dead tree laying next to, like, a dead tree that's still standing next to our house, we might want to cut it down before the hurricane, or, what I'm saying, like, kind of take care of your yard,
Yeah, that's so true, man. I think, when we talk about everything with the inverted yield curve, things going on with Russia, Ukraine, just the uncertainty in the market, you want to be able to hedge yourself accordingly. And I definitely agree with you on the crypto side. I'm very bullish on a lot of different cryptos, but Bitcoin is really the basis, the fundamental of my crypto portfolio. And I did just want to say, I do have an affiliate link in my show notes if you all are wanting to get 10% off on the Bitcoin 22 conference, which is going to be April 6th to the 9th in Miami Beach, Florida. But, everything around this Bitcoin, it really just shows you need to have a store of value. You want something that can't be controlled, that can't be manipulated, that's decentralized. And when we think about our dollar-based system, the reason why it's lost a lot of value is because it can be manipulated. The Federal Reserve can print money at ease. So you want to not only have things like Bitcoin, but also when we talk about utility coins like Ethereum, Solana, Cardano, all of these different coins that are in the smart contract, in the NFT space, in the metaverse space. So I wanted to kind of finish this conversation off. I know you had some great charts talking about the Bitcoin's dominance network, talking a little bit about the halving and how we have that coming up pretty soon with this year, and just getting your thoughts on the dollar index. Did you kind of want to share that with the audience?
Perfect. All right. So this is basically a tool chart that I've been looking at and kind of just getting my bias and kind of like market interpretation as far as bull runs and when, altcoins will make their run and things of that nature. So what this is a chart from TradingView. It's the Bitcoin, and the ticker symbol is BTC.D, which is the Bitcoin's dominance over the crypto market cap. And so taking a look back in time, you can see 2016 and prior, obviously Bitcoin was, 100% dominant for the most part. The 2016 halving took place, and that's when there's a drop in the supply of Bitcoin that can be mined. So it makes it more scarce, which usually implies a price jump. And so what I've notated here is pretty much, and it happens every 4 years. So what I notated is kind of like the start percent-wise of the dominance to, for the past 4 years from 2017 to now. And so basically it appears that 2 years after the halving is when the price peaks. So in 2016, there's the halving. Then 2017, the bull run started, and it didn't end until 2018. And so this is when Bitcoin first hit 20K. Then from there, we had the bear cycle. So, it kind of just shows how at the peak of the bull run, the dominance across the Bitcoin or the crypto market was 35.7%. Once that bear market hit, it rose back up to 70%. And then the last halving took place in 2020. And now, we're 2022. And so I'm looking, so on the right here, this black area, I measured the size of the last drop in dominance. And so for technical traders, basically this is a rising wedge right here that I have drawn out. And so usually, if you measure the, I'll kind of consider it like a flagpole. If you measure the flagpole from top or from bottom to top, that is kind of what you would expect coming out of this pattern on the forecasting end. So taking a look at that, where I believe this screenshot was taken back in December, of last year, December 18th. So it just kind of shows where price was going into 2022. And so right here is basically a consolidation breakout pattern that was forming. And so, now everything going on, I'm pretty much looking for at some point this year for, price to break out and make new lows. And so to go in tandem with that.
And do you feel like with looking at that chart, do you feel like, this year is going to be a peak year, or are we going to pretty much stay in consolidation and maybe form some new lows for Bitcoin?
I think we're going to hit new highs, and then we'll finally hit that peak
Start to
that
come
we're
down a
looking
little.
for. Yeah, exactly. And then kind of start the cycle all over again, because the next halving is set for 2024. And this is like a really good source that I use too to help kind of use it as like a confluence with that BTC dominance chart that I've broken down. So this website is called Look Into Bitcoin, and it has some really good market cycle charts that I look at. So I was kind of give like a live look at the main charts I look. I mean, obviously the main market cycle chart is the stock to flow model, but what I found really effective as well is the pull multiple and the Bitcoin investor tool 2-year MA multiplier. So this one is like shows the relationship between daily, Bitcoin issuance as far as like what miners are dealing with. And so to kind of quickly illustrate this one, so this is like the actual price chart line graph of, Bitcoin's price up here. And this is kind of what the pull multiple is as far as like miners dealing with, as far as like how their profitability goes and everything like that. And the green zone is like the buying indicator. Whenever it dips inside of this green zone, it's like a solid buy indicator. And then when it pushes into this red indicator, it's a good sell indicator. So we haven't, so when you look at previous prices, 2016, the halving, and then like I said, 2018 was the peak of that bull run. It hasn't came back down up into that area. So we're basically still in that bull run, basically meaning we still have a lot of opportunity. And then looking at the 2-year MA multiplier, it basically confirms the same thing as well. So whenever price hits this or hits or drops below this green line, it's a buy signal.
And what is the price, just to kind of give like what you're seeing? I can see it a little bit, but what is the price dropping below where it will be in the green area? What prices are you seeing as far as the buying and the selling zones that is shown?
For sure. So I guess what I'll start with is like maybe the like a timeline. So for example, 2020, when Bitcoin dropped down to like that 5K area, and then it pretty much ran up until last year, up until that like 63K area. That 63K area was pretty much at that resistance area here, but it never went all the way into it like it did back in 2018 at that peak.
I see.
And so now, when right now it seems is very pessimistic as far as like, Bitcoin's been dropping since the new year. Taking a look at it, it never, it still hasn't dropped back in here, but that basically still signals that, hey, like since we're in a bull run, we've never hit that final resistance of the peak. So technically it doesn't have to hit down here again because it never hit up here yet. Because technically this doesn't really count. Like what this looks like, and I'll show on my actual trading view chart, is really just a consolidation right here between, 63 and 30K. And it's like, it's a ascending triangle. I can't draw it on here right here, but basically this is consolidation for like a breakout higher. And, that higher point would, technically be, somewhere around 100,000, which other people have kind of insinuated or what they're trying to anticipate.
Yeah, I definitely think that, Bitcoin has a lot of potential to continue to form some new highs this year with everything going on. It's just, it shows why it's a necessity to be able to hedge against like our monetary system and just having a store of value.
Yeah, that's the major thing. It's really just about being able to store your value. That's why, stocks are important, because you really want to, stocks historically have always been the best hedge against inflation. So it's, even if, inflation is 14-7%, anything like that, stocks over the long term are great, hedges of that to have your money in, because it's pretty liquid as well. If you need to sell a stock to get your cash back, you can, you're more than likely able to do that. Whereas, holding your wealth in kind of most of the time illiquid assets can kind of sometimes be a trouble to do, such as a house sometimes in a bad market, and crypto is borderless. So, if everyone earlier in the year saw that video of, Afghanistan, refugees trying to all get on that plane and everything like that. they couldn't take anything with them. If they had gold, they wouldn't be able to. But if they had, a crypto wallet or a cell phone, you know what I mean, they were going to be able to take their wealth with them regardless of where they went.
Yeah, that borderless is so important, man. Just to have self sovereignty, where you can go anywhere in the world and you don't have to worry about it being seized, or having your money just taken from you. So I mean, that's the bullish case in its own of why having it in your portfolio as an investor gives you a good hedge for a multitude of things.
Yeah, so now I think it's up and clear. So I guess what I'll really start is kind of going back to 2020, where on that 2-year MA chart, will it load up? Okay, perfect. So on the 2020 MA chart, where it showed price kind of dipped into that green area.
Yeah.
This was that area right here on the actual Bitcoin chart. And that was the last low before, price went on this major run from, about 4,000 all the way up to that 63,000 right here. We've pretty much, been, the new low, really solid support has been this 30,000 region, making higher lows. And so we're basically looking to make a higher highs. And so this is kind of like my outlook, kind of going in tandem with that BTC dominance chart, with those market cycle graphs and where price is now. Because it looks like we have kind of bottomed out, and with all the macroeconomic factors taking place, it wouldn't be a bad time or, a bad indication of, price kind of having this type of movement. And taking it over to Ethereum, it has a similar type of outlook as well. So Ethereum is making that same type of flag pattern or pennant as it did previously to get up to 4,000. And now this is just a larger one. So we have the, higher high, higher low, higher high, higher low. And it looks like it's bottomed out. We just broke past the trend line. And so what I'm expecting is for price to end up, it may not be as clean as this, but I could definitely see it running back up to that previous high, maybe passing it, getting a retest, and then continuing up to further this bull run, at least in the summer months here.
I agree. And I think that with Ethereum, they're working on, their 2.0 staking protocol, which they said that should be coming sometime over the summer, like July. So, I think Ethereum has a lot of room to run, especially a lot of these NFT projects. They all use Ethereum for their smart contract, information that you have to use for those protocols. So I think, man, between that and also Bitcoin, Bitcoin definitely has the potential to continue to form some higher highs, and like you said, I think it will form some lows as far as maybe consolidating through certain areas. But yeah, this is all good information for sure, man. I did want to just tell you this was just a great conversation, and I thank you all for listening to us and watching for this long. I know this one was pretty long, but a lot of valuable information that you take and you can share with someone else, because you always can learn more by sharing it with your friends and your family. But Bryan, can you kind of just share your social media if anyone wants to connect with you, learn more about trading and different things like that? How can they reach out to you?
Oh, for sure. You can link me. My Instagram is Bryan, BRYAN _ lap, LAP, the number 8. From there, you can check out the ebooks as well. Link is in the bio. Money, the Currency of Illusion, and Crypto, the People's Currency. And from there, definitely tune in to my guy Kevin and his, insightful, principles podcast and Instagram page as well.
I appreciate it so much, man. And thank you once again, bro, for coming on. I really enjoyed this conversation, man.
Oh, sure. Every time, man. Every time.
Yeah. Well, everyone, thank you for listening and watching to another episode, and we'll see you next time.